Welcome back, you legends. I'm Dr. Khan. Let's get right into this weekly update video. Now, I'm going to go through a bunch of really critical indicators this week, guys, that talk about sentiment, breadth, and a bunch of historical data. If you're interested in the day-to-day technical analysis, please check out the last video that I uploaded. And I do want to thank everybody for supporting me. I pulled up my channel's page, guys, because I just want to show you how crazy this ride has been for me. Just a couple of weeks ago, I was getting about 1,000 views per video. 3 weeks ago, I was getting about 500 to 700 views per video. And my last video has gotten 5,000 views. I'm so thankful, guys. I'm so humbled by your support. Thank you, thank you, thank you so much. This is my passion. This is what I love doing. I love to talk about technicals, the market, talk about different indicators, and share my thoughts with everybody. So thank you, everybody, for your support. I know there's been a lot of new viewers that came to my channel, and if you just take a quick look at my thumbnails, you might think, oh, this dude, he's a perma bear. He's just super bearish all the time. The reality is, guys, that we've been in a bear market since January, and I've been bearish throughout this move to the downside, but I did play these counter trend rallies. I played this counter trend rally, I played this counter trend rally, I played this one, and I played a bunch of counter trend rallies here as well. So yes, we are in a bear market. Yes, things look grim with the Fed hiking rates, but data is changing all the time, guys, and I want to be data dependent. And so in this video, I'm going to go through a lot of data that will help us navigate this upcoming week, which is going to be an absolute insane trading week, guys. By the way, guys, I do have some family things that I need to take care of. I need to take a flight. And so I do want to apologize in advance if next week I do miss a couple of video uploads. I'm going to try my best, guys, to upload videos. And if you are in the Discord community, I'll be live covering the stock market every day, but it's just going to be a tight schedule to upload these videos. Anyway, let's get this started. This black line, guys, is the VWAP, the volume weighted average. And it was anchored to the top. I anchored it to the top. And if you just notice very quickly, guys, we got a rejection right here. And we're getting very close to another rejection. And I want to show you some more stuff, guys. We do have this 38% Fibonacci retracement level coming in at roughly 4,100 on the SPX. And another Fibonacci retracement line, guys, if I put this up right here from the top to the bottom, we also have a 50% retracement, really right around those same levels. We have a descending 20-day moving average. We also have a couple of Fibonacci resistance lines here, guys, and the volume weighted average. So a lot of indicators are pointing towards a major resistance right around here. And that also makes sense because this acted as prior support and we had a bunch of choppy trading here. And so, guys, we do have a lot of trapped supply right here. And so I'm very cautious from the long side and the very short term. I think we will try to break through, but I think this resistance line will be very significant. And we do have CPI coming in. And so, guys, I need to ask myself this question. Do I want to be positioned long as we are approaching these major resistance lines and as CPI is coming out? If we were sitting at a support level, guys, I'd be much more inclined to hold a long position going into CPI because I actually think CPI will be coming down. And I think this CPI figure and the PPI figure both will be bullish. My opinion, that's just my opinion based on the data that I've been seeing. But the technicals worry me a little bit because I do not want to enter at resistance when we are running into a major binary event that could go either way. I hope that makes sense, guys. From a weekly perspective, we're bouncing off the 125 weekly moving average. We still have the 200 weekly moving average running below us. Overall, this does look like a bullish candle, right? We opened above last week's close and we closed above last week's high. And so overall, this does look bullish so far. But please, guys, remember that we've seen things like this before, right? This week, for example, we had a very bullish week. This was a big green candle, guys, for the majority of the week, and then we reversed the very last day. And so this was the same story, guys. Very big green bullish candle, and then we completely reversed. And so I do need to see more price action. I need to see more I need to see more structure develop. And if we start taking out these major resistance lines, if we retake the volume weighted average, I might start to rethink, okay? But so far, I mean, just look at the volume. Significant selling volume. This buying volume is below the last 3 weeks, the average of the last 3 weeks. So I'm not entirely convinced just yet. And in terms of seasonality, guys, we do tend to see some strength in the very early days of September. I did talk about this. I pull up this seasonality chart basically in every video that I upload. And I've pointed out, guys, many times that we do tend to see some bullishness towards the first half of September. And that bullishness ends right around the middle of September. So my expectation is still the same, guys. I think next week will be bullish overall, especially if the CPI figures come out significantly below expectations. I think that will be very bullish for equities. The question though, guys, will that bullishness simply match seasonality and then we'll get a dump after the end of next week? And so do we rally towards September 16th and then we reverse the week after that? That is the $1 million question, right? We simply cannot know at this point, but overall, I am still leaning somewhat more bearish than bullish. Now, I do want to pull up this slide. This slide is from AAPL, guys. Please check out their videos. Amazing content on YouTube. Now, I did pull up this signal in a previous weekly update video, and this signal talks about this, guys. It talks about the S&P 500 closing at its first 21-day low after closing at a 42-day high when the market is below its 200-day moving average. It's a lot of jargon, guys, I know, but basically what they're saying is that this signal looks at this. One, we need to be in a bear market that has declined by 20% or more. We got that, right? We had it decline by 20%. Then we need to see a counter trend rally that goes all the way up to the 200 daily moving average. We got that. After that, we need to see a quick and fast rejection. And that's what happened. And so it looks at this pattern: bear market backdrop, then a counter trend rally that goes all the way up to the 200 daily moving average and get a quick rejection. So it looks at this pattern, okay? And when they ran the numbers, guys, from the signal date, the average drawdown after that rejection was 20% and the median was about 12.5%. And so what does that look like? It looks like this. It looks like a reversal and a sell-off all the way down to right around 3,500 on the SPX. So just around the 200 weekly moving average, this deep blue line, okay? And that does make sense, right? The worst case scenario, guys, is 3,200, and that would take us to this lower range right here at the bottom of this consolidation zone. And that also makes sense, right? Now, for this to happen, guys, we do need to see two major things. One, we need to see CPI, inflation, being more stubborn, being more sticky. And number two, we need to see the reaction by the Fed turning even more hawkish. Now, that would, in my opinion, result in another leg of selling. Now, guys, the alternative is this. This is another study based on a significant breadth thrust, and it looks at the maximum drawdowns in a bear market backdrop when 90% of the S&P 500 components close above their 50-day moving average. And so this is a breadth signal. This is a signal that looks at how many stocks in the S&P 500 have managed to close above their 50-day moving average after the market had declined by 20%. And from the date of that signal, guys, the maximum drawdown that we've seen based on historical data is to 3,800. And so we do have these two competing themes, right? On the more bearish side, we have this theme that says we'll go down to 3,500 to test the 200 weekly moving average and perhaps even undercut that and go to 3,200. And in my opinion, guys, that is the likely scenario if inflation continues to be stubborn. But on the more bullish side, guys, if inflation continues to come down significantly and the Fed begins to ease on its hawkish tone, this is the more likely scenario where 3,800 is probably going to be the maximum potential drawdown. We could simply just rally off 3,900 and never look back. That is possible. Anything is possible, really. but we do have a lot of headwinds working against us, including unfavorable seasonality, including a lot of geopolitical tensions, China, Taiwan, Russia, Europe, a hawkish Fed, and uncertainty about inflation. So a lot of things. Now, with all of that being said, how is the market positioning at this moment? Now, guys, if you do follow sentiment and things like that, you will have seen this reading all over the place on social media. 53% bearish sentiment as of September the 7th. An extreme bearish reading, right? So a lot of people are saying, oh, look at this, sentiment is extremely bearish, and this tends to be a contrarian indicator, and so there is a very strong possibility of a short squeeze rally. And to that I say, yeah, sure, but keep in mind that the market has actually been positioning in a bullish bias. Even though sentiment is very bearish, the market has been actually positioning in a bullish bias, and I'm going to prove that to you. This is the IWM divided by the S&P 500. This is a ratio chart, and it tracks the performance of the Russell 2000 in comparison to the much larger cap companies in the S&P 500. And so, guys, when we do get a close above the 50-week moving average, that tends to be a major risk on signal, indicating that a major rally is coming. And we're really on the cusp of that, right? We're hugging the 50-weekly moving average. We're clearly in a bull flag formation waiting for a breakout. Now, in addition to that, guys, let's take a look at the momentum ETF. And again, look at this, guys. We had a close below the 20 weekly moving average, and then we completely reversed and closed above that and above last week's open. And so momentum is also bullish. PPO is pointing up. And on the daily time frame, guys, we're getting very close to taking back the 20-day moving average, and we're hovering above the 50-day moving average. So momentum and small caps both are signaling positioning with a bullish bias in the market. And I have another chart to show you. This is XLU. This is utilities, one of the most defensive sectors in the S&P 500. And look at that, we're sitting at near all-time highs on XLU, but we do have negative momentum. We haven't seen a bullish crossover just yet. And if we take a look at the ratio chart, XLU divided by the S&P, we do have this nasty rejection doji, right? This is a very bearish rejection reversal candle because the price rallied to the upside and then completely reversed to the downside and closed below the open. So this is a very bearish tombstone looking candle, and we're getting rejected right at the crossover point. And so again, this indicates to me that yeah, the market was bearish going into September, but now the market is turning more bullish. And so even though sentiment is very negative, traders are saying that they're being negative, but they're actually buying stocks. That's the problem. Here's another chart that I want to show you guys. AAII sentiment survey. Bulls are collapsing and bears are persistent. But recall monthly AAII asset allocation survey. Equity exposure has remained above average all year. So sentiment and positioning continue to be historically out of balance. So what has been happening, guys, is that traders have been saying one thing and doing the opposite. They've been saying that they're bearish, but they've been buying stocks. And so that's a problem. Here's another problem, guys. Look at this. Institutional option trading activity is on par with the financial crisis. This is absolute insanity. I haven't seen a chart like this in years. This is the institutional trader net speculative option premiums as a percent of the US stock market cap. And the last time we had this insane level of hedging, guys, was in the 2008 financial crisis. And so institutional investors, guys, are positioning themselves long, but they're also buying protection. They're buying puts. And the vast majority of those puts expire by the end of next week. That's another big issue. This is max pain for next week, and it's sitting at 405, so flat from this week's close basically. And just look at the amount of open contracts with a put to call ratio of 1.6, so 60% more puts. And just look at the volume of open contracts, absolutely insane. Now, just to give you a perspective of how insane this is, let's take a look at the week right after. Look at that. Nearly 10 times the amount of open options expiring next week. And so here's the problem, guys. Market makers make money by selling option contracts, and they make the most amount of money when the most amount of those option contracts expire worthless. And so from a market manipulation point of view, market makers need for the S&P 500 to close above all of these options so that they will all expire worthless. That's how they make the most amount of money. And so with this much negative positioning, I do not think that next week we'll see a sell-off. I actually think the opposite. We either run flat or see a rally after the CPI, again following seasonality, right? We don't tend to see problems in September until the middle of September. And so after all of these options expire worthless, there's really nothing to protect the market from moving down, because all of these guys work as really stop losses. Market makers will try to manipulate as much as they can so the market does not close below these option strikes. And so these options really act as buy walls. And so we're clearly seeing a push-pull dynamic here. We're seeing hedge funds being so bearish, retail traders being so bearish. We do have the CPI next week, and it all makes for prime market conditions to see a short squeeze rally, sucking in more bulls, and then possibly dumping on all of those bulls in the second half of September. And so all of the bears will lose their money next week, and all of the bulls will lose their money the week after. That's unfortunately how the market works, guys. You have to approach it from this perspective, that the market is evil, the market is looking to take my money. We all know the market is amoral, right? It's not evil, it's not good, it doesn't care. It's just an efficient market. And when so many people are bearish, it makes sense for the market to want to move in the other direction. And so in the very short term, I still think that we'll see some rallies, perhaps some chop move sideways in the S&P 500 throughout next week. It will all depend on what happens with the CPI. The really big question, guys, is that after the CPI comes out, and if it is good and we do see a rally, is that the recovery? Is that really the beginning of the recovery? Or is that just another bear market rally and we get another rejection on September the 21st when the Fed meeting takes place, the September Fed meeting? Because remember, guys, the Fed was not happy about this rally. So many FOMC members came out publicly criticizing the market for rallying because they do not want to see market conditions loosening. That makes their job much harder to fight inflation. While a declining stock market and a declining bond market, taking liquidity out, tightening financial conditions, that's what they want to see. And so even if CPI data is good, the question still remains, will this be a bear market rally, sucking in more bulls, possibly filling this gap if we get a really insane, like a not so rally? And so the question, guys, is this going to be a bear market rally? And will the Fed come out again with another sober reminder, just like it did late August and it led to this massive sell-off? Will that happen again? That's really the big question. And really, there's no clear answer other than the fact that it's in the Fed's best interest to see the stock market cool down. It's not in their best interest to see the stock market rallying. Now, I did talk in detail about why that is the case in my Crash Farther video, Crash Farther Part 2. Please check out that video if you're interested in why the Fed needs the stock market to go down. I talked at length in that video just about that topic. Now, I do have more charts to show you guys. This is the percent of S&P 500 stocks above their 200-day moving average. This is another breadth indicator. And I looked at all the prior times where we had a decline to 11 and a run to 40 and a rejection at 40. Unfortunately, I did not find any prior time where we had breadth collapse to 11% and rally to 40%. The closest that I found were back here in 2008 when breadth collapsed to 21 and then it rallied to above 40 and rejected, and that led to this small sell-off right here. A second rejection led to this massive sell-off. And so the question now, guys, are we going to see another rejection or are we going to break out of this resistance line? Now, another example was in 2011, guys. We had a rejection right around the same levels that we've seen this year, and then we had one last push to the downside. It was about 10%, so very similar to the last sell-off that we've seen, which was 10%. And from there, guys, we just rallied and never looked back. But again, we need to see a crossover here. We do not want to see a rejection look like this. Same thing happened, guys, in 2015. After rejection, we had another sell-off, about a 15% sell-off, and once we broke through, we never looked back. And so that's what I'm watching. That's what I'm going to be watching over September and October. Will we be able to cross back over? I tend to believe that we will cross back over and see a nice November, December holiday rally. Now let's take a look at this chart. This is the percent of stocks above their 200-day moving average. This looks at all stocks in the stock market, not just the S&P 500. So it is a much broader breadth indicator. And in this case, guys, I did find a couple of really close examples. Again, the 2011 example, we had a 10% drawdown and then we rallied. We had a 10% drawdown just in the last couple of weeks. And so the question is, are we going to rally? And in 2008, guys, we had the exact same thing, right? We had a rejection, we sold off, and then we moved back up, made a lower high, rejected again here, and then we had a massive collapse. So far, guys, market conditions today are nothing like they were in 2008. Remember, guys, in September 2008, the Lehman Brothers collapse was already old news, right? We haven't seen any big collapses yet. That is possible. We could see that, but we just haven't seen anything like that just yet. The jobs market was also declining throughout 2007 and 2008. We haven't seen that yet. The jobs market continues to strengthen. And so, guys, so far the economy has been holding up. And so I do not think that we'll see a collapse like this. The market conditions simply are not saying that we'll see something like this. I think this is a more likely scenario, a 10% and then a move up. Or perhaps something like this, a 15% and then a move up. So we could still see more selling, taking us down to 3,800, perhaps even testing the June lows. That is all possible. I just don't think that market conditions are suggesting a collapse like 2008. At least not yet, perhaps later next year, just not yet. Going back to the AAPL Bull Bear Survey, guys, I just wanted to take a look at what it meant by cross-matching it with S&P 500 performance. And unfortunately, it's not a reliable signal because at times it can occur right before a sell-off. Other times, the market just moves sideways. And so it's all over the place. In this example, we had the last sell-off and then we moved up. In this example, we had more selling to come. In this example, we came really close to the bottom. In this example, this was the bottom. In this example, we were already moving up. In this example, we had more selling to come. And now we don't really know what's going to happen. It really all depends on what happens with the CPI and the Fed. This is another breadth indicator that I want to show you, and it's the up-down volume. And we've hit a major level, over 90% up volume last Friday. And this signal, guys, tends to correspond with short-term tops. Back here, the top came in just a couple of days later. Back here, guys, the top also came just a few days later. And so in general, guys, it tends to correspond with short-term reversals. So we might see a couple more days of buying. Again, that goes along with the thesis that the CPI is going to be good. We'll see a rally, let's say, Tuesday on CPI. We'll see a rally Wednesday on PPI, for example. And then the market might very well close in the green by the end of the week. And then we could see the reversal the week after that when the Fed meeting takes place. And so, guys, to summarize, yes, sentiment is very bearish going into CPI. That could allow for a short squeeze. Net asset allocation is still positive for equities. And so big money managers have been buying equities. They've just been hedging using puts. And that to me says that the market will likely move up next week, allowing all of those puts to expire worthless and perhaps see a reversal the week after that. That also lines up with seasonality. And so that's how I'm looking at the market at the moment, guys. I think we will see something that goes along with market seasonality. We might actually see a pretty strong short squeeze, and then that back half of September sell-off might actually make a higher low, not a lower low. And so, guys, we could see a rejection at 4,100. We could see a rally to 4,200 and a rejection there, and then a pullback to 4,000 to fill this gap, creating a higher low, and that will signal to a lot of money managers that this is a new uptrend, and I suspect that they will pour back into the market. So that's one scenario that I could see. Another possibility, guys, is that we see a rejection here. We go back to 3,800, form a lower low, form a higher low on the PPO, right? Forming a divergence and then a rally to the upside. In my opinion, guys, it's really going to depend on what happens at the Fed meeting. Are they going to match market expectations with a 75 basis point hike? And so, guys, over the next couple of weeks, we have to understand that the market will be driven by news and less so by technicals. Technicals are going to help us pick spots, but the direction, the major directional changes are going to be based on what happens with CPI and the Fed. I hope that makes sense. Thank you, everybody, for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.